Okay, we're back. We're going to do a little bit more. We finally moved to the next slide, or we're going to move to the next slide. This is where we were stuck. But here's the next slide, which is corporations are not allowed to make special allocations. We talked about that a little bit. It has to be in the percentage of shares held. The percentage of shares held. Now this gets to one more lesson to work into here, which is the fact that there is this one class stock rule that we've been learning about. One class of stock that S corporations have to have. They can't have two classes. And over the course of history, it's come out to the following regulation that the IRS has agreed to, and this is how the law is being interpreted. You can have a class of stock that is voting. You can have a class of stock that is non-voting, and you can have all kinds of varieties like this. And small businesses want sometimes to have shares with voting stock and some to have non-voting stock, and it's important for them to have that. So the Treasury Department, the IRS, has pretty much agreed that the one class of stock rule basically means the following. You do not violate the one class of stock rule as long as you, A, only allocate income, losses, and special separately stated items based on the percentage of shareholdings, and B, that any distributions made, whether it's cash or properties, are also made, just like here, in the percentage of shares held. So if you follow that rule, you can have voting, you can have non-voting, you can have shares of stock that require you to bring bananas to the meetings, you can have shares of stock that require you to bring apples to the meeting. You can do whatever you want as long as you follow the A and B. No special allocations. All allocations are in percentage of shares held, and distributions of money and property, that's what this would be up here, usually money, are made based on the percentage of shares held. And then you don't violate the one class of stock rule. That's pretty important, so make sure you got that. Again, use the textbook to go over that. Okay, moving right along, we spoke about compensation. In the S corporation environment, it's basically how low can you go. The lower the better, because you avoid paying that Social Security tax. You're going to pay that. You got to pay the ordinary income tax, which is the A portion of salary, and the B is FICA. But if you can have the money pass through, if you can have the income pass through from the S corporation to the shareholder without doing it through salary, without doing it through compensation, you save this. You don't have to pay that. And in case you didn't follow this, one more time. If the amount of cash earned or amount of income earned, this is the income earned is $1,000. If you pass that all out as a salary to the individual shareholder, again, this is an S corp, this is the shareholder. If you pass it all out as salary, W-2 wage, it's going to be subject to ordinary tax and the Social Security, FICA. Next example. Take the same $1,000, pay $100 in salary, so that'll come out to the shareholder and be taxed both ways, just like up there, ordinary and Social Security. But it'll reduce the income after the salary to $900. That'll just get passed through the K-1. This is a W-2. The K-1 will go for $900, and that's only going to be subject to the ordinary tax. You'll save taxes. All right. Here's factors in determining reasonable compensation. This is the opposite of our discussion about C corporations, of factors that determine whether the compensation can be very high, which was a benefit. C corporation, it was higher, it was the benefit. S corporation, the lower. So here we want to zero on things that will cause reasonable compensation to be lower in the S corporation, but this works both ways. This works for C's and S's because it's all the same factors that have to be taken into consideration as to whether the compensation is reasonable. And reasonable would be anything that is sounds right, and unreasonable would be it's too high or too low. That's the idea. So what's the training and experience? What are the duties, responsibilities, time, effort? What kind of dividend history? This will apply more to the C corporation than to the S corporation. What kind of salaries are paid to the non-shareholder employees? Maybe the shareholder employee is doing the same thing that the non-shareholder employees are doing, so the salary that would be reasonable would be the amount that the non-shareholders get, because they're only going to work if you pay them a reasonable salary. How you pay, and this is a big one right here, biggie. What do comparable business pay for similar services? Then what's your agreement? Is there a formula? These are all factors that come into play for purposes of determining whether your salary is reasonable. And you can see that it's a facts and circumstance test. It's based on all these factors, circumstances. So this becomes a highly controversial area to decide, because how we judge it might be different than the IRS judges it, and we wind up with a lot of tax court cases over what's reasonable compensation. Wonderful. All right, fringe benefits. On to a couple points that have to be brought out in a class of this nature. When it comes to fringe benefits, S corporations can offer the same fringe benefits as others, but if you're a more than 2% shareholder, then you get treated like partners for fringe benefits, which basically we'll cover more when we get to the partnership rules, but you might as well know it for now. And that is, more than 2% shareholder employees, the basic rule is that the fringe benefit that is being paid is not deductible. That's the main thing to get out of this. Not deductible at the corporation level. Cannot be deducted by the S corporation. So you got the S corporation is paying fringe benefits for non-shareholders, and that's deductible. Perfect, no problem. And the whole idea, of course, is to the non-shareholders, it's a tax-free fringe benefit. That's what we're talking about now. And those are determined under the Revenue Code, so I'm not going to go through that because that's part of the 323 class. But the main thing is that non-shareholders getting a fringe benefit that's tax-free remains tax-free to the non-shareholder employees. What happens, however, is that when it comes to the more than 2% shareholders, everything's fine except for the fact that it's for the S corporation to shareholders. The fringe benefit is not deductible. And because of that, the shareholders wind up having to pay tax on the money. So you can offer the same benefits, but that doesn't mean you're going to get the same tax benefit. That's the whole idea. All right? These are some of the items that it applies to. These are all non-tax-free, let me restate, these are all tax-free fringe benefits to employees. I was going to say non-taxable. Same idea. These are tax-free fringe benefits. If paid by the corporation, they're deductible by the corporation, but the individual employee doesn't have to pay tax. But, as you see, must be included in the wages of the 2% shareholders who are employees. Charitable contributions. Since this is a pass-through entity, S corporations make those charitable contributions. The charitable contribution shows up on the, you guessed it, the K1. Whatever amounts is paid to charity shows up on the K1. So if it's $1,000, that gets passed through to the shareholders on the K1. And if there's more than one shareholder, the $1,000 is broken up according to percentage shareholding. So let's say we have a 20%, we have a 30% and a 50% shareholder. So $300 of the charity goes to shareholder A. And this is, I know, highly advanced math, but it's good for you. and 500 to shareholder C. Now, what happens at the shareholders level with shareholder A, B, and C is they put this on their individual 1040 as an itemized deduction of charity, and maybe they get a deduction, maybe they don't get a deduction. It all depends on what's on their individual return, but they get the ability to try to take it on their individual return. Whether they get tax benefit from it or not depends on their own individual situation, and we can't control that, and the S Corporation doesn't have anything to do with that. The S Corporation has done what it had to do by telling the individuals, shareholders, how much charity has been taken by the corporation, and allocates, according to the percentage shareholding, the individual's amount that they can pick up on their individual return, and if they can use it, fine. If they can't, that's the way it goes. And that also illustrates just the fact that you got an S corporation, which is the pass-through, passes through to the shareholders, the separately stated items like we talked about in class, including the net income, rental income, or other income, which is non-separately stated, and however it ends up vis-a-vis the K1 on the 1040 of the shareholders, that's an individual call. The S Corporation just, all it does is passes it through. It cannot force the individual to get the deduction. It can't make it happen. The individual might have losses, it might have gains, it might have other things going on, which may change the nature of the K1's information pass through, but that's just the way the tax law works. It has to work that way. All right, the good news is that the S Corporation has no alternative minimum tax. However, it may have AMT items, meaning faster depreciation or add-backs that AMT has, preference items, and they will be, you guessed it, told to the shareholders vis-a-vis the K1, and they'll be passed through to the shareholders. So it gets passed through to shareholders doesn't mean it causes the shareholder to have to pay an alternative minimum tax. You guessed it again, it'll all depend on that individual shareholder's 1040 as to whether it causes an AMT or not. All right, let's see. Let's hold here. We'll come back and we may get close to finishing up.